So in this video we're going to talk about inheritance tax. Now, first thing to say is this is not a detailed guide to inheritance tax, otherwise it would be several hours long. Inheritance tax is complex, but I'm going to give you the bare bones and all the core principles. Then what I'd urge you to do is contact, if your affairs are complicated, a tax advisor, or even try the website of the tax people, which is www.hmrc.gov.uk. Okay, and I'll scribble that up at the end as well. So, inheritance tax, basic principles coming up. Now, you might think that dying would get you out of paying tax. And obviously it does, in one sense, get you out of paying tax. If I die tomorrow, I'm not going to be writing any checks. But unfortunately, you do leave a potential tax liability on death to the people you leave behind. So apologies for the fact this video combines two fairly grim topics, tax and death. All right, but inheritance tax is definitely one to watch out for. And the reason you need to watch out for it is because the best way to get around it, as we'll see, is to give stuff away. All right, in fact, inheritance tax has been described as the tax on trust, because if you don't trust the rest of your family, you're not going to give your assets away. So when you die, you're going to leave a big death estate, and that's going to get clobbered for inheritance tax. Okay, now first point of confusion is this. Inheritance tax is not the same as capital gains tax. So don't get confused. Let me explain what I mean there. Whilst basically I am still alive, and let's hope I make it at least to the end of this video, we have two taxes that I might suffer. One is income tax. That's fine, on my salary and any interest income and so on. And the other is something called capital gains tax. Now that arises when I sell shares, sell second properties, if I'm fortunate enough to do that, and that's a tax on the profit, so the difference between the buying and the selling price. So there's a tax on income, so that would be, say, rent from a property, and there's a tax on the profit, or you hope you make a profit, from the difference between what you pay and what you sell it for. Now, on death, you become liable for a completely separate tax called inheritance tax. And boy, is there scope for confusion between these two. All right, income tax, most people don't get confused about. That's pretty self-explanatory. You can only earn income while you're alive, and that is potentially taxed. But over here, there's confusion. So in this video, I'm focusing solely on this one. All right, in another video, I might focus on this one. But the point is this: when I start saying things like you can give assets away, like property, for example, and it could get you out of paying inheritance tax on death, don't think I'm talking about this one, because giving stuff away doesn't get you out of paying capital gains tax, believe it or not, but giving stuff away early enough can get you out of paying inheritance tax. So first point up front, please don't think I'm talking about this tax, I'm talking about this one. All right, the rules are different. So it's the tax on death. So let's take a look at how it works. Now in one sense, it's brutally simple. Income tax is fiddly, this one over here. You've got different rates, different bands. Am I a higher rate? Am I a lower rate taxpayer? Am I a non-taxpayer? Inheritance tax is pretty brutal because in very simple terms, it works like this, okay? Now, first of all, there's only one rate, basically. Not going to go into trusts in this video. There's only one rate of inheritance tax. So what you do, well, obviously, if I die tomorrow, hopefully I've left a will, and that's a good planning point at the end of this video. So I've left a will, so somebody, perhaps a member of my family, will act as my executor. And that means they find my will, so hopefully I've filed it somewhere where they can find it. And what they're going to have to do is gather together a list of all my assets. That's called my death estate. I mean all my assets. So if I've got a property, that's in the list. That's got to be valued at market value or an estimate of market value. My cash in the bank, any shares I own. You can deduct outstanding debts potentially. So you come up with this figure for Tim's death estate, and that takes a bit of work actually, and there are rules about how you go about that and how long you've got. But you've got a death estate And basically that will be valued and then hit for 40%. And that's your inheritance tax. All right? And in simple terms, there's only one way to reduce this bill, basically. And that is that at the moment, the first £325,000 of any death estate escapes. So what I could do is get my death estate together, for argument's sake, a few £100,000 of death estate, deduct the first £325,000. That's the exempt amount, and the rest is hit for 40%. Okay, so if the death estate was £1 million, you take £325,000 off. That would leave you with £675,000, and that will be clobbered at 40%. Okay, and that normally needs to be paid. Could be quite a large amount if you think about a wealthy family or a wealthy person dying. That normally needs to be paid within 6 months of the end of the month of death. All right, although you can apply to the Inland Revenue to pay in instalments over a longer period. All right, so it's a fairly brutal tax. There is no lower rate as such, but there's a big exemption. So for a lot of people, okay, once they put their house and all their other assets in, you know, if you are leaving behind less than £325,000, then your executor, so that could be, for example, in my case, my brother, for argument's sake, basically won't have to worry about inheritance tax, but die with a death estate of more than £325,000, and there might be a problem. Okay, so there's the basics of inheritance tax. So a few questions. First of all, who pays it? Now again, the rules are technical, but one point worth making up front. Inheritance tax rests on you being, on death, what they call a UK domicile. So the question of who, and again, I'm not going to go into all the detail on this in this video. Right, it's a basic introductory video. But inheritance tax is driven by your domicile. Now your domicile is your permanent legal home. And all I'd say is, if you're talking to a tax advisor or you're looking up some more on this, domicile is not the same as your nationality, necessarily. And it's also not the same as your residence. Residence is a term that tends to drive the income tax and capital gains tax rules. Domicile, your permanent legal home, is what drives inheritance tax, and it's sticky. The difference between residence and domicile, in a nutshell, is residence is relatively easy to change depending on where you're located, but domicile isn't. It's your permanent legal home. So where you're born, okay, obviously influences that. Where your parents have spent most of their lives obviously influences that as well. All right, so if they're British, for example, and they happen to have you on a day trip to France, doesn't make you French for inheritance tax purposes, if you see what I mean. So there are rules about what your domicile is when you're born, and it's quite difficult to shake it off. It's also quite hard to acquire. UK domicile, you can't just apply for overnight. So bear that in mind. Who's liable for this tax? UK domiciles is the answer. All right, not the same answer as you would get if you were looking, for example, necessarily at capital gains tax or income tax. So how can you get around this tax? You know, if you're going to leave behind a big death estate, is there a way to reduce it? All right, now ideally, of course, you want to get it down to no more than, let's say, 325,000, because imagine if your death estate was 325,000, you'd knock off the exemption, and then your executor would write a check at some point for nothing, okay, because 40% of zero is zero. But the point is, how do you bring this down if your death estate is potentially, let's say, £1 million, lucky you, how are you going to bring that down so that on the point where you die it's around 325,000 or even below 325,000? Okay, well, first of all, if you're married, all right, or you have a legally recognised partner, so if you've got a civil partner, all right, or a wife, you can potentially double up that 325,000. You can make it as a couple 650,000. Here's how, because the first, basically, let's call it exemption. The first one is a gift to a spouse or civil partner. All right, now, The effect of this is this. If I were to die, what I could do is leave all of my assets to my wife. All right. Now, there's no limit on that, so any assets in my name just pass straight to my wife. Now that means I haven't used my 325,000 exemption. I didn't need to, because all gifts, if you like, on death to a wife, everything that passes to a wife is exempt anyway. So then when she dies, the Inland Revenue will say, well actually, Tim never got to use his 325,000 exemption, and now his wife qualifies for her own 325,000 exemption, so between them they should be entitled to a £650,000 exemption. And so whoever the executor is when my wife dies can make an application to the Inland Revenue to have the limit doubled, if you like. So whatever is left in my wife's name, you can knock £650,000 off at that point. So that's quite useful. So spouses can pass assets on death between themselves, all right? And that's that effectively then doubles up the amount you can exclude based on that £325,000 exemption or free amount. Now the next one, there are various ways of making gifts to other people. All right, so on death, everything can pass to my wife, and that's fine. That's not a problem. What about other people? Other gifts. Okay, and these potentially are other ways to minimise the tax. Now I won't run through every single one of them, but I'll run through one or two of the most common ones. So, for example, gifts to political parties, and registered charities can escape. Now, what do I mean by that? What I mean is that the gift can be made by the person while they're still alive, and if they were then to die, okay, or even if they don't make the gift when they're alive but leave a gift to a political party in their will, so the gift is sort of made on death, last possible moment if you like, it escapes the death estate of the person who's died, and therefore whoever the executor is doesn't have to worry about paying 40% on it. So that's how the gifts is, you know, giving stuff away. Certain political parties qualify, there are rules, so you can't just create a sort of Mickey Mouse political party you know, run by your mate, give them everything in your will and expect that your death estate won't get taxed. It's got to be a recognised political party, and there are rules about those, and a registered charity. So for example, the National Trust qualifies. And actually the National Trust end up with quite a few properties on their books. One imagines that one possible scenario is a very wealthy property owner dies, suddenly the estate is faced with an inheritance tax bill of 40% the value of the property. They're thinking, we haven't got that kind of cash, because don't forget, you have to write the cheque in cash. Where are we going to find that kind of money? 40% of several million, the big family pile. How on earth are we going to find that kind of money? So, you know, you think, well, okay, one option would be to maybe gift, come to an arrangement with the National Trust, gift the property to the National Trust. Maybe we can carry on living in one part of it. Maybe visitors can come around and so on and so forth, and maybe we can minimise the inheritance tax liability that way. Okay, so a charitable arrangement like that might work. Now, that won't apply to everybody, so what else? You can make gifts out of income, okay, while you're still alive. Now, there are tests for this. Tests basically about, can I afford to do it, as far as the Inland Revenue is concerned. But for example, as Tim Bennett, I can make regular gifts out of income, and provided the Inland Revenue is satisfied that the amount doesn't affect my lifestyle, in short, that I can afford it without sort of bankrupting myself, okay, or putting myself in poverty, then they'll allow me to give away assets. And if I were to then sort of die, you know, a few years after making these gifts, those gifts would be considered outside my death estate for inheritance tax purposes. And also that whoever got those gifts also wouldn't have to worry about them for inheritance tax at that point. So regular gifts out of income. Then there's a 3,000 exemption for an annual gift to any one person. So I could say to my brother, I'm going to give you £3,000 this year, and if I were to drop dead a week after making that gift, the £3,000 would be outside my death estate and wouldn't be taxable in his hands either for inheritance tax purposes. And I could do that every year for 10 years. I can make much smaller gifts to anybody I like, apart from, say, my brother, of £250. So that's the small gift exemption. And you can do as many of those as you like. That's useful for grandparents, for example, thinking about giving their grandchildren Christmas presents in cash. Okay, lucky grandchildren. So basically the way that works is, in addition to the £3,000 annual gift to, say, my brother, the one person, I can make £250 small gifts. So I get my chequebook out, chequebook slightly old-fashioned, £250 to anybody I like, as many times as I like, as long as each recipient only gets £250. The point of that rule really is to cover situations like birthdays and Christmas. Okay, you make a small gift of 100 quid, let's say, to somebody for their 18th birthday. You don't want to be immediately clobbered for inheritance tax if basically you were then to drop dead the day later. All right, so small gifts escape too. There are, we haven't got to the big one yet, there are things like wedding gifts. So parents can give their children £5,000 each, grandparents can give £2,500, and anybody else, so your mates, if you're lucky enough that they want to give you that kind of money, can give you up to £1,000, and there are no inheritance tax consequences if the gift is a wedding gift. Okay, so bear in mind there are various ways of sneaking around, but these are all, you're probably getting a feeling this is all a bit bitty in a way. Wedding gifts, well, that's fine, that's not going to happen every day. £3,000, well, that's all right, but you can only do that once a year to one person. £250 small gift, well, I suppose I could write loads of £250 cheques, but that's still not talking large amounts of money necessarily if you're running a sort of big, potentially big death estate, if you've got big assets. And yeah, political parties and charities, well, maybe I do want to do that, maybe I don't. So there is a big one missing, and it's this. All right, there is a thing called a PET. A potentially exempt transfer. All right. Now I'm aware I haven't covered all of the inheritance tax exemptions here, but this is a biggie. No limit on this, so there's no £250 or £3,000. All right. Basically, this says you can give any amount, so cash, for example, could be an asset, to anyone you like under inheritance tax rules, and provided you survive, believe it or not, 7 years after making the gift, it escapes your death estate as the person who made the gift. Okay. Now, where they got 7 years from is quite an interesting question. Actually, it's not an interesting question at all. It's just a random rule of tax, and there are plenty of those about. Okay, there have been moves to try and get it up to 10, but it's stuck at 7. It's a 7-year rule, and it is called the potentially exempt transfer because this is how it works. Supposing I was thinking, right, I'm not feeling brilliant today shooting this video, so I don't reckon I've got, this is tax for you, I don't reckon I've got much more than about 10 years left in me. Okay, how am I going to reduce my death estate so that I don't basically leave my family with some horrible inheritance tax bill? Well, what I need to do, potentially, if I'm not going to use the fact I can give it to my wife and so on, if it's somebody else, so I want to start giving assets away to other members of my family, brothers, friends, is literally I have to start making the gifts as soon as possible. And the idea is, so for example, supposing I were to gift some assets, like some shares or a property, now, if I survive at least 7 years after making the gift, then the property escapes my death estate. It's considered outside it, and the recipient doesn't have to worry about inheritance tax at any point as far as my death estate is concerned either. But if I were to make the gift and then not survive 7 years, now obviously it's quite difficult to know whether you can survive 7 years or not, but that's tax for you. If I were to make the gift and then survive for say 3 years, then there is potentially an inheritance tax liability. I won't go through the exact calculation, it's on a kind of sliding scale, on the gift that I made 3 years earlier. I've got to survive the full 7, and then believe it or not, as soon as I do, the inheritance tax liability on that gift falls to 0. And there's no limit on the amount. It's not a maximum of £3,000. I can give away as much as I want whenever I want, provided I survive at least 7 years after doing so. And that's called a potentially exempt transfer. We're potentially exempt because obviously until I survive 7 years, I don't know for sure whether I've made the gift in time. All right, and that's tax for you. If you think that's bizarre, it is. All right, so that's a big tax planning point. You're giving assets away. Now, who you give them away to? Good question, because you've got to give them away properly. You can't pretend. All right, the Inland Revenue are smarter than that. You can't sort of say, come to an arrangement with a family member and say, well, can we sort of, half-heartedly, can I give something away but I want it back? Okay, like a property, for example. The Inland Revenue will test that and say, well, did you really make a bona fide gift? Change the name on the title deeds if it's property, for example, or were you kind of just pretending to try and get out of inheritance tax? So there are, you know, ways they audit that, but essentially giving assets away, provided you want to give them away, works well. Okay, so families with lots of assets, you know, the name of the game, provided the people at the top of the family trust the people at the bottom, is to start giving assets away if you think the death estate is going to be fairly sizable, you know, well over potentially 2 times £325,000, which will be exempt anyway. All right, so I'm going to finish off with 1 or 2 planning points. That's a whirlwind tour of inheritance tax. Plenty of things, little bits and pieces I didn't cover. So let's just finish up those just the basic principles with 1 or 2 admin planning points, if you like, stuff that's sensible to do. Okay, and I'm a big fan of sensible stuff, so some obvious points when you're dealing with inheritance tax or thinking about it. Number 1, make a will. Everyone should have one. There are surveys that suggest that only about 40% of us do, and that's a little scary, and the reason is simply this. You want to know where your assets are going on death. You know, when I die, I want to know who's getting the assets they own. Now, if you've got a spouse, you know, by default, you can simply, the will can be very short. It can just say everything goes to my wife, and after that it goes to my child, for example. But the point is, if you don't make a will, and it could be a very simple document, if you don't make a will, then the intestacy rules, as they're called, the law kicks in, and it's a bit of a pain. Okay, you don't want to have to follow the statutory provisions in terms of where assets end up. You want to have just written a will, and that then settles the issue of where your assets go on death. So, okay, it might cost you a bit of money at solicitor. It's not a fortune. Get a will done. First piece of advice. Okay, you're going to leave a lot of stress behind if you don't, basically. Number 2 is, if you're going to end up with a big death estate, now, easy for me to say this, you know, if you think as a couple your death estate is going to exceed, when the second one of you dies, £650,000, then start to think about how you're going to give assets away and when. The earlier you do it, the better. Okay, now, this is a touchy topic because in some families, you know, for example, people may not trust their children, you may not want to give assets away to the children, that's fine, but if you're going to, do it early, or as early as you can, because of that 7-year rule, all right, which will mean that if you haven't done it at least 7 years before death, potentially the asset doesn't escape inheritance tax, or doesn't fully escape inheritance tax. Okay, and the third thing is, because this has been a whirlwind tour, I'm just going to put that website address up again. Okay, Inland Revenue website, much more user-friendly than it used to be, as are the people who work at the Inland Revenue. They're not as scary as they were once. Okay, so they will talk you through all this stuff, and there's some quite good information there. But my advice would be, you know, for the detail, not a bad place to start, hmrc.gov.uk, and or obviously a tax advisor, particularly if you've got a reasonably large or complex death estate. And that's inheritance tax.